Okay, dear students, we are ready to begin our long hike, our long march up the mountain. That is the world of stocks. Oh boy, I hate that word. How about businesses? Eh? Yeah. Yeah, we're going to spend a little much time because there's much to learn. So study hard and bring honor and glory to Southwestern Community College, your family, your friends, your colleagues, and of course yourself. Let's start with a few quotes. This is from Will Rogers, a humorist from the mid 20th century, who said, "Don't gamble, take all your savings and buy some good stock and hold it till it goes up. And if it don't go up, don't buy it." Yeah. Great advice there, Will. Well, his generation knew what they were talking about because they saw their cohorts, maybe some of them themselves, get destroyed by the Great Depression, where stocks lost. Well, I forget exactly, but I think it was not almost 90% of their value. Yeah. How do you make a small fortune in the stock market? Well, it's easy. Start with a large fortune. And so we are going to do our best to show you the good news about businesses, stocks, but also to show you that you should be wary, that there are dragons, there are pitfalls, there are times when you're going to lose money, maybe a whole lot of money. And if the world doesn't end, though, we should do okay. If the world does end, doesn't matter where your money is. Slide number 2. What are stocks? Again, I like to use the word business. Stocks represent ownership in a corporation. Where did the term common stocks come from? Well, these entities, these corporations, started after the Renaissance when the European powers were colonizing and exploring the world, and they needed capital, they needed resources. So the corporations would I'm sorry, that's the right word, elicit? They would solicit shareholders in common. Every one share that you owned gave you a vote, and of course, if you had many more shares, you had more ability to affect what happened with the corporation. We use the term equities. That's a term from accounting, which means ownership. So we say that stocks are equity financing. This enables investors to participate in the profits and the growth generated by the business itself, because why are businesses in business? To make money. But one thing that we don't think about often is that when you're a stockholder, you have limited liability. You're a limited liability owner, unlike a sole proprietorship where you and the business are basically the same, or the partnership where the partners and the business are the same. And you would learn more about this in an introduction to business class and a business law class. As we said, maybe I made mention, some people try to take advantage of this and use corporations to hide their assets. And there are ways for the courts to pierce the corporate veil to say, no. You created this corporation for one thing, and that's to hide assets. And no, you're not going to get away with it. But some people do. One of them's was in the White House. Anyway, stockholders receive optionally dividends, payments of earnings, distribution of earnings. You accountants know all about that. And then capital gains or capital losses. The value of the corporation rises as the business grows, and the stock should follow, although it doesn't always follow in a straight line. Contrary to what many people believe and how many people behave, stocks are not simply millions upon millions of worthless pieces of paper. Well, no, electronic bits, all the paper's gone, that people trade each day. They represent ownership in real businesses. So when you buy one share of FedEx, you're a part owner of that entity. Now, your part is that left, the lug nut on the left front tire. Because these corporations, some of them are huge, and we are small little investors. But hey, it allows you to participate in the growth, in the success or lack thereof of businesses. Historical performance on slide number 3. over the long term of finance, modern finance, and there's a reason why we use the term modern. We're talking the early 20th century. The stock market has averaged approximately 10% to 11%. Actually, that's not pretty bad. That's pretty, I'm going to say that's pretty good, yeah. But in any one year, it is unlikely that the return will be 10 or 11%, right? The return has varied from a high of almost 54% to a low of over minus 43%. And so we said, as we hammered away in chapter 1, stocks are volatile. The standard deviation, the variance is great. 2008 was almost minus 40%, one of the worst. And if you went from peak to trough, it was 56% or so down. And in any given year, there has been a 1 in 3 or 1 in 4 chance of a down market. Now, wouldn't it be nice if it went up 3 years in a row and then down and then up 3 years in a row and then, no, it doesn't work that way. The major exception was the great run up from 1982 to 2000, and then stocks went down 3 years in a row. So you just don't know. As we hammered away in chapter 1, we know that we're going to have down years. We just don't know when, and so we don't panic when the markets fall. Because as we said, if the whole thing falls apart and there's no food at the grocery store, there's no shoes at the mall, there's no gas at the gas station, the cell phones aren't working, the energy's not being pumped out by utilities, the houses, the hospitals, the banks, the fire departments, the schools are all shuttered. It doesn't matter where your money is, folks. Failure is not an option. I think so. Slide number 4. Here's our revisited graph from chapter 1, where we showed that stocks really have just clobbered everything else, folks. And it just makes sense when you think about the exponential rise in our standard of living. Somebody waking up from a 100-year nap or a 200-year nap would be just, they could not fathom our current standard of living. It's exponentially better, meaning it's a whole lot better. Then how come we're not happy? I haven't figured that one out yet. But still, we see that stocks have done very well over the long term. And there's that logarithmic scale we have to worry about. These little squiggles, these little downturns don't look very big. But when you look at them in an arithmetic scale, yeah. But even with all the volatility, stocks have clobbered the other alternatives. Now, we're not, the real estate investors, relax. We're going to get to you later. That's a whole different world. But yes, real estate has done very well also. So let's continue. Here's the same graph from chapter 1 over 200 years. And it's just astounding what we've been able to do. And as I've said in the past, I try not to be Pollyannish, folks. I try to instill in you a solid skepticism of before jumping in. But I firmly believe that the next 20, 30 years are going to be the most prosperous years in the history of the world, assuming we don't blow ourselves up, die in our own ways, turn into hellish 1984 Brave New World dystopias. It's a major possibility. But economically, I'm very, very optimistic. Slide number 6. But, the big but. There's always a but, right? There's always a however. What about yet? And hence, let's take a look at this. Therefore, it's not on the straight line. It doesn't go up in a straight line. And so what we're going to do in this graph on slide number 6 is we're going to break it up into 10-year periods. Now, this is the Dow Jones Industrial Average, which we'll discuss in a future presentation. It's one of those measurements that we use to see how stocks have done. And it's one of the oldest. In fact, it is the second oldest. The transport index is actually a few years older than that. 1896, I think, is when the Dow came out. Okay, so we go back to right before the Great Depression. And we put some money in here in 1928. And 10 years later, in 1937, we had lost money. Same thing is true for 29 and 30. So those were 10-year periods where stocks actually went down. Okay, well, we start coming out of the Great Recession, World War II, and new technologies, science, the atomic age, the 50s, the go-go 50s and the go-go 60s, and it's modern world, folks. And stocks went in two directions, up and way up. And what did you hear people say? Ooh, 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 is it too late to get in? Look at what stocks have done, almost 20% over the last 10 years, right? Yeah. When you hear people say, is it too late to get in? It's usually too late to get in, because what happened? 1960s, we had the cultural revolution, civil rights, women's rights, gay rights, the Vietnam War, and the 1970s were a very difficult time for the stock market and the economy. Stocks were very highly priced, right? Because they had done very well over 20 years, and people said it's too late to get in. And sure enough, we had Watergate and the first oil crisis, and we see a time when stocks went down over 50% in 1972 and 73. And we see a time when stocks almost went negative over a 10-year period. Not quite, but people got drubbed and people got hit. Some people got hit a whole lot hard, especially if they went with some of the companies that were called the Nifty 50. These were companies that you could not lose money with. You might have heard of some of them: Polaroid or Xerox, Calcomp, Tektronix, Metro Media. You haven't heard of those companies. Or maybe you heard of Xerox and maybe Polaroid, but I wouldn't want to own a company that the name rhymes with hemorrhoid. I just wouldn't want to do that. Anyway, in 1975, 1976, you heard people say, is it too late to get out? And when you hear that, it is too late to get out, because what was going on in the 70s? The baby boom generation. All the things that we said there were important, but the most important thing was the baby boom generation coming of age and all needing to find jobs and housing and shoes and refrigerators. And it was a very difficult time for the economy. And so the economy has its ability where, assuming we get up in the morning and put our clothes on and go to work and do the things that we need to do, produce the goods and services, it heals itself eventually, hopefully. Nothing's perfect. And sure enough, we start coming out of that hard time with the 1980s and globalization and miniaturization of electronics and computers, PCs, and then cell phones that were as big as a brick. And then stocks responded, and they went in up two directions, up and way up. And sure enough, blue skies, internet, unbelievable. Just it's as far as the eye can see, productivity gains, and the stock market went in two directions, up and way up. And sure enough, you saw 10-year periods where you almost received 20% a year. And that's pretty darn good, folks. And here's the year 2000 and Y2K. And what did you hear people say? Ooh, is it too late to get in? Yeah. Now, I didn't think it was going to start going down in 2000. I thought maybe 2003 or so, but we knew it was going to happen. I remember looking at some of these stocks and thinking, no, come on, they're just not going to. And most of them disappeared, many of the internet companies. Some of them stuck around. But sure enough, we had the internet bubble bursting, followed by the real estate bubble bursting. And then you had 10-year periods where the stock market went negative. You put your $1,000 in, and 10 years later, it was less than $1,000. And what did you hear people say? Oh, is it too late to get out? In the 2008 and 9. Now, some of you were very young at the time, but I remember it very well. And I tried to convince one of my clients that no, we're going to come back. We're not going to. Well, there was a time, though, when it looked like the global financial crisis could have affected permanently. It could have really destroyed the world economy, and you got to hand it to. I think you do. A lot of people, some people don't, but I think the Treasury and the Federal Reserve Bank in the United States and the reserve banks in the developed world, I thought they handled it as best they could with the horrible situation it was. And sure enough, we're coming out of it, or we have come out of it. And you see 10-year periods, around 10%, some a little higher. Are we going to do exactly the same kind of cycle where you see returns going way high? I don't think so. I think it's going to be moderated, but I don't know. It's the future. But as I said, I'm very optimistic, and I'm still very much invested in stocks, and I'm old. Slide number 7. Historically, close to half of the return from stocks was from reinvested dividends. You see, stockholders used to expect 4, 5, 6% in dividends each year. That's very unusual now, but some companies do pay that. This was as much or often more than what bonds were returning in interest, since stocks were considered much riskier than bonds. So if you go from 1936 to 2008, you see that stocks returned about 4%, 3.8% in dividends. Some more, some less. The growth stocks don't tend to not to pay dividends. But then what happened in the 1980s, 1990s is investors were very turned off, very dissuaded by dividends. We don't want dividends. No, we want you to build the company. We want you to grow the company. Take those retained earnings, plow them back into the company, and grow the company. And so what happened is the dividend between 97 and 2007 averaged about 1.5%. And now it's even less than 1.5% as of this time we're recording this. The reasons given are varied. Dividends were taxed at a much higher rate than capital gains. People wanted the business to reinvest the earnings for growth instead of distributing it to the investors. Stocks were no longer considered riskier than bonds. I don't know. Some people were saying, "Oh yeah, stocks are not as risky as bonds." What substance are you imbibing in? So savings accounts were also paying less than 2%. Well, that's true, but now interest rates have gone up a little bit, so some savings accounts are paying 4%. People lost track of their senses and bid up the prices. That's usually the real reason. People just gimme, gimme, gimme. Greed. There's an old saying that there's 3 forces that move the markets: greed, fear, and greed. That's actually 2, right? But greed usually wins out. Slide number 8. So here is the historical performance of the yield on bonds, the interest rate we get from bonds, and the dividend rate we get from stocks. And so you go back to 1960s, and you see that they were fairly close. The stock market was returning 3.8% or so, and the bond market was returning 4.3%. And then what happened? Well, we had the huge downturn in 1973, 72, 73, which stock prices went down quite a bit, and so the yield goes up if the stocks continue to pay dividends. And at the same time, inflation started to raise its ugly head in the 1970s. As we said, the baby boom generation coming of age. And sure enough, bond yields started rising and rising and rising. And finally, at the end of the 1970s, inflation looked really bad. And we had a president by the name of Jimmy Carter. I know some people have a hard time believing that. We had a president named Jimmy. But he appointed the new Federal Reserve Bank Chairman, Paul Volcker. And you might see some photos of him with his big cigar. He always carried around a huge cigar. And President Carter said, we have to do something about inflation. And Mr. Volcker said, yes, Mr. President, we can do that, but it'll probably cost you the election. We will ratchet up interest rates. And to his credit, unlike the current president, he said, you do what you have to do. And Biden said the same thing. You do what you have to do. I have to worry about what I have to worry about. If I get reelected, I get reelected. If not, oh well. And sure enough, it did. It wasn't the only thing. It was the Iran-Contra affair. And if you were interested, and the gas crisis of 79. A lot of things went bad for Mr. Carter. And sure enough, they raised interest rates to the point where it broke the back of inflation and also created the worst recession since the Great Depression. But it did the job. And what we see is now interest rates falling as inflation falling, and we see the dividend yield on stocks falling as stocks continued to rise and go in two directions, up and way up until 2000, when blue skies, Y2K, the sky's the limit, and we hit 1% on the dividend yield. And I was still kind of, maybe we got a couple more years left of this. No. That's when it hit. March of 2000, 1% on the dividend. We're close now. We're at 1.3 or something like that. And so, yeah, that's when the internet bubble burst. And we see interest rates continue to fall as we went through a recession. And then 2008. 2008 was a very difficult year, folks. Stocks went down tremendously, and so the dividend yield goes up. Bonds plummeted the interest rates because the Federal Reserve was now putting their foot firmly on the gas pedal, bringing interest rates down to 0%. And when you see that, folks, it's usually a pretty darn good sign that stocks are going to do well. Of course, you're in the middle of the great financial crisis, the global financial crisis, the Great Recession. Who wants to buy stocks? Yeah, but that was the time to buy. And we start to see them bouncing around, and we see interest rates of bonds falling to just unheard of levels. Just less than 1%. Some were 2%. Again, that's not natural. And we always knew that interest rates were going to come back up. We just didn't know how. And of course, the virus, COVID, did its thing, and the Federal Reserve had to raise interest rates in 2022, and we see the bond yield going back up to where it had been back in 1960, around 4%. But we still see the dividend yield falling. So some people might say, look, stocks have a long way to fall before we get back to where it was in the 1960s. But, that doesn't mean it's going to have to happen that way. We just don't know. As we said, more people are interested in not in dividends, in growth. We don't want dividends. And so we'll see what happens. But as I say, I'm going to repeat myself. I'm very optimistic. We'll see. Slide number 9. The pendulum swings. The bear markets of 2000 to 2002 and 2008 changed investors' perceptions about dividends. We now see investors and companies focusing more and more attention on dividends. I love dividends. Dividends don't lie. Everything you read in the financial statements, all the numbers that are published, they could all be lies. And sometimes they are, like Enron. But the one thing that they can't lie about is the dividends. Why? Because they sent you a check. Well, they don't send a check anymore. It's all electronic, but you get the idea. And what happened is some tech companies, which were considered growth companies like Microsoft and Apple, they had money coming out of their ears. Billions of dollars is sitting in the bank. And so, hey, it's time to start distributing those earnings to the shareholders. And so now they're some of the best dividend companies. Yeah. And the tax law has changed so that dividends are taxed roughly the same as capital gains. So there's this book called Dividends Don't Lie. The book is not that great. Actually, they updated it, and it's now called Dividends Still Don't Lie. But the name, I love the name. I love that name. I grabbed on that name. Dividends Don't Lie. And this quote is attributed to John Rockefeller, of the Rockefeller Center in New York. We don't know if he actually said it because his neighbor said he said it. So, do you know the only thing that gives me pleasure is to see my dividends coming in? Well, I agree with him. I love dividends. But it's not the only thing that gives me pleasure, thankfully. Slide number 10. Have you heard the terms bull market and bear markets? Yeah, bull markets are favorable markets, normally associated with rising prices, investor optimism, economic recovery, government stimulus, where bear markets are unfavorable markets, normally associated with falling prices, pessimism, and slowdowns and government restraint. Where do these terms come from? Well, there are some stories about where the terms come from. Bulls charge ahead and throw their opponents up in the air, and bears are more reclusive, but when they do attack, they knock their opponents down. I don't know. Check it out. If you're the kind of person who loves, is it entomology? Is that entomology or is it etymology? One of the two. He loves the origin of words. You check it out. But just remember, bull markets are rising stock prices, bear markets are falling. Now, we don't call it a bear market until it's fallen 20%. If it's fallen 5, 10, 15%, that's a correction. You decide whether you want to remember that or not, but it's what you're going to hear. You're going to learn it just from being in the industry. Slide number 11. So to recap, what are the pros and cons of stock ownership? Well, as we said, we allow the general public to share in the rewards of the business enterprise. They've been the best financial investment returns over time, giving us optional dividends and optional capital gains. And I put the word financial in there so that the real estate agents don't jump up and down, scream and holler. They're easy to buy and sell. They're very liquid, unlike real estate. And we talked about the limited liability, right? That if you have one share at $100 and the corporation goes bankrupt and they still have a lot of debts, you can't come after you and say, hey, pony up more money. No, you've lost your investment and that's all you can lose. And one thing that we don't think about too often is the fact that this system, capitalism, it may be the worst possible economic system ever developed, except for all the others. These corporations and this entity, this system called capitalism, has created an increased standard of living for everyone. And most all countries around the world have said, me some too. They've seen what the West has been able to do. And I always said, this was back in the 70s and 80s when people were complaining about communism. I say, look, you want to change communism? Don't build another aircraft carrier. Drop blue jeans and Walkmans. You don't remember what Walkmans were. Drop VHSs, videotaping and televisions and stereos. Bomb Cuba and Russia with all the goods and services, with dishwashers and washing machines, and you'll get rid of communism real fast. Excuse me. What are the cons? Well, yes, we talked about the risk, the volatility, the popular euphemism for, hey, I lost a lot of money. Oh, yeah, stock's been volatile. And then there's corporate and financial industry hanky-panky. But if we stick with the big companies, folks, that have been around for decades, it's not likely we're going to be touched by that hanky-panky. If we go with smaller companies, hot new issues, as they're called, we might get burned. But even still, some big companies sometimes do, especially this was an issue over 20 years ago with Enron and WorldCom and Global Crossing and Tyco, and oh my goodness, they were cooking the books. And funny thing is, I don't think anybody went to jail, which is really, really sad. One guy was supposed to go to jail, and then he supposedly died. Who knows where he is now? He's probably in Argentina. Slide number 12. Volatility examined. So this is the S&P 500 for 2024. And we start with $10,000. And if we just left on January 1st, went to a deserted island with no internet, who would want to do that? And came back at December 31st, we've done pretty darn well, up to 22%. Not bad, huh? But what if we were watching the news and we saw, oh my goodness, it went up 10, 11%. Okay, I'm going to jump in now. And then drops 7, 8%. Oh, wait, get out. Only to see it go up another 10, 11%. Oh, okay, get out. No, it just dropped again. Oh my goodness. And then I'm never going to get back in. And then you see it go up another 15%. Yeah, folks, what can I say? If you follow the day-to-day movements of the stock market and think you're going to make investment decisions, well, first of all, we don't use that word investment. We say speculations, trades, gambling. I wish you a lot of luck because you're going to need it. It ain't easy. And we talked about John Gutfreund and John Merriweather. You're up against the best in the business, and now you're up against computers with artificial intelligence, which probably is much of it artificial, but some of it must be good, and they can do millions of trades a minute, and so you're way outgunned, folks. So invest for the long term. As Mike Gitlin says, invest, don't trade. Okay, so you excited? I hope so, because we've got a long way to go. In our next presentation, we'll discuss the stock markets. We often say the word stock market, we use the term stock market, but it's actually many markets. So we're going to take a look at what's going on, where is it going on, and we're just getting started. I hope you're excited. Thank you so much for being in our class, and we want you to be rich. So stocks for the long run. See you in our next presentation.